Now, in this section of India 16, we're going to focus on and talk about how do you look at the whole recognition and measurement aspect for any property, plant, and equipment. So we will, whether it is plant and machinery, vehicles, computers, furniture, fixtures. So whatever you see, or for that matter, building, right? So whatever you see as property, plant, and equipment, which is what we just talked about as a tangible asset, how do you now record and account for them, and how much to measure? How do you measure each of the expenditure which you have incurred in relation to such asset, whether they qualify for capitalization or not, is what we aim to cover and discuss as part of this section. So when you look at the recognition part, what is most important principle is that the cost can be reliably measured. That's the first question, is what you need to understand, and then whether the economic benefits of the cost what you have incurred, whether that will flow to the entity or not. If, for example, we have to take a view that I've incurred certain cost, but there's no benefit which will flow to me as part of that cost, then essentially it doesn't qualify as a property, plant, and equipment. Because when you go back to the definition, right, what you see is that it has to be either used for the purpose of production or supply of goods or services, or for rental, or for administrative purpose. Now, if you were to say that I cannot use it for any purpose, right, whatsoever, that means the economic benefit will not flow to the entity. If there is no economic benefit, then it doesn't meet the definition of property, plant, and equipment. And the other element is important, is to say that can I measure the cost of what I have incurred in relation to this particular property, plant, and equipment? If the answer to that is yes, then it is eligible for capitalization, and we will go through that in more detail. So when you look at the benefits, right, how do you look at the benefit for any property, plant, and equipment? It can be direct or it can be indirect, right? Future benefit may be direct, or future benefit may be indirect. Direct benefit in the form of usage or disposal of the asset, and we talked about, like, whether it's for production or for administrative purpose or for rental, etc. Now, when you look at an indirect benefit, it could also be acquired for safety or environmental reasons, qualify for recognition as asset because they enable an entity to derive future economic benefit from related assets in excess of what could be derived had those items not been acquired. A very simple example, let's say you have a manufacturing plant, right? Now, if you have a manufacturing plant and you can manufacture the goods what you intend to do, for example, a cement plant or a mobile manufacturing, or for that matter electronics or anything like that. But let's say if the plant is actually producing waste, right, or is polluting, and then now I need to actually install equipments which is going to help me manage pollution. Now, the process of managing pollution is actually not adding to the quality of the output from the plant, but what is helping you is to manage the environment, and let's say, or meet the regulatory requirement for your plant continue to be operational. And that's, let's say, is being termed here as and something which is an indirect benefit. So whether a benefit which you derive from that asset class is tangible, it has to be a tangible asset, and you can derive either directly or indirectly. It has to be used. There has to be an economic benefit which has to flow to the entity, and that benefit could be direct or indirect. If the answer to that is yes, then it meets the criteria in a way for capitalization. An asset cannot be accounted if the cost of the asset cannot be measured reliably. So we talked about, remember, first principle also, that the cost also has to be measured reliably. So for example, if I've said that I've incurred cost to build this large building, right, but I have no account as to how much I've spent on this. Now, if you don't have any account of how much you spent on this, the question is that how will you capitalize? And hence it is important for you to also be able to reliably measure the amount which you have spent on this particular asset, and the benefit of this has to also flow to the entity direct or indirect, it has to flow to the entity over the period of time. It's not that immediately everything has to be realizable, since they are to be used over a longer period of time. So you need to be mindful of that, and in a way look at that the benefits also flow over a period of time. That's the reason that they are being called as capital expenditure. Now we're going to look at aggregation, right? So many a times it happens that you end up acquiring small value assets, right? So how do we capitalize them, for example? Or what is the unit of account at which I need to capitalize them? It is important for us to understand the unit of account, because at whatever level you're going to capitalize them, that level you need to then depreciate them, measure them, test it for impairment, etc., etc. So all of this is important. It's a judgment area. The standard does not prescribe the unit of measure for recognition, what constitute an item of property, plant, and equipment. So we talked about it, that you need to look at that, what constitute an item of property, plant, and equipment. It has to be something where you can generate, right? You should be able to generate future economic benefit, right? That is inherent or fundamental to the whole concept of property, plant, and equipment, right? You should be able to generate future economic benefit from the purchase of that asset, either by way of use it in production process, or by administrative purpose, or by giving it on rent to others. So you got to apply judgment. It's a judgmental area for recognition criteria for an entity specific circumstances. Many a times it is appropriate to aggregate individually insignificant items such as molds, tools, dies, and to apply the criteria to the aggregate value, right? And so on and so forth. But you also need to be mindful that when you capitalize in aggregate, what controls you have put in place in a way to monitor these assets. For example, let's say I'm buying a chair, right? I'm buying a chair. Now individually a chair may cost you 2,000 rupees, 5,000 rupees. Now if it's a large company, that's an immaterial amount. Now let's say if I purchase 100,000 chairs, right, in one single order, then suddenly the cost become material, and hence then I need to capitalize them, right? And if I were to capitalize them, then do I want to capitalize them as one single item, or I want to capitalize them at each of the separate item? And that's where you need to exercise judgment. You need to be cautious to say that how do you demonstrate that these assets are appropriately accounted for, right? In a way, do I have enough controls appropriately accounted for, right? Do I have enough controls here in terms of, so do I have controls to ensure that these assets are not going to be misappropriated, right? So have I done enough listing of all of these items? So when you're making, more often than not, we end up seeing the fixed asset register of companies where they end up recording every item as a separate line item in their fixed assets register, which then gets aggregated on similar type of assets for the purpose of determination of depreciation rate as may be applicable on them. So it is important for you to understand the concept around aggregation, which is again not provided for in the accounting standard. And hence it's an area where we need to apply judgment appropriately, from that perspective, and in a way deal with this, as we in a way move forward. Now I'm going to talk to you about this concept on spare parts. So first we've talked about the primary assets. So let's say you have a plant and machinery, but for you to maintain the plant and machinery in a working condition, many a times we need the spare parts, right? The question we often struggle is that a spare part, whether it has to be accounted for as part of Ind AS 16, which is a property, plant, and equipment, or it has to be accounted for as part of inventory. And again, there's an area which often require judgment. Spare parts, standby equipment, and servicing equipment are recognized in accordance with Ind AS when they meet the definition of property, plant, and equipment. Otherwise, such items are classified as inventory. Now, why again this distinction is important is when it is classified as part of Ind AS 16, then it is mandatory in a way that you have to start providing depreciation to that component of spare part as well, right from day one. Now, if it is not classified as part of property, plant, and equipment, but is classified as part of inventory, then you are not required to provide for any depreciation. As you know, the inventory valuation rules are cost or market price, whichever is lower. And hence, this distinction is important for us to understand. Now, when you look at this example, there's this aircraft company, operates a fleet of helicopter. It holds a large stock of rotable spares, which is an integral part of helicopter. The spares have a life of more than 1 year. Now, when you look at this definition, again, it meets the definition that is held for goods and services, and the life is again more than 1 year. If it meets the definition of property, plant, and equipment, the answer that it should get then capitalized as spare part under Ind AS 16, and then you'd also start providing for depreciation under Ind AS 16. So this distinction is important for us to understand, that whether it will classified as part of property, plant, and equipment, or it will be classified as part of inventory. And once you're clear on that, then of course accounting will be fairly simple from there onward. So moving forward now to talk about elements of cost as to what all go into an item of property, plant, and equipment. And now we will try and also cover this with the help of several examples. So cost includes all cost in bringing the asset to the present location and condition. And that is a very, very important thing for you to understand, that includes all costs which are relevant from this asset to bring it to its present condition and location, where you can actually deploy them, where you can actually start benefiting out of that asset. So what are the different elements of cost? When you look at that, it's a purchase cost, it's a directly attributable cost, as well as there are other elements of cost, all of them put together in a way a part of purchase cost. So it's the purchase price, is the import duty, and non-refundable taxes. If there are any discounts or rebates which have been given to you, that you need to exclude from the cost of the fixed asset. Similarly, if the direct attributable employee benefit cost, if there are cost of site preparation, delivery and handling cost, transport handling charges, installation and assembly cost, testing cost, professional fees, all of that is what is going to form part of your directly attributable cost. And similarly, this is an important concept like initial estimate of dismantling cost, which is to say that if you have taken a property on lease, and now you know that after or I have acquired an asset, right, and I have to give this asset back to the asset owner. And if I have to give this asset back to the asset owner, I then need to restore to its original condition and location. If that been the case, that cost is also required to be factored in and also required to be capitalized as part of Ind AS 16. And we will try and understand this with the help of an example as we progress. So all of that is what, whether it's a site restoration cost or whether it's a dismantling cost. Let's say you set up a power plant, right? Now, when I've set up the power plant, the land which I've taken from the government was, let's say, on 30-year lease. I've set up the power plant, and the government regulations suggest that once the power plant come to an end to its life, which is 30 years, I have to return the land to the government in its original condition and situation. That is where the restoration cost is what I need to incur. Similarly, if I have to dismantle the whole thing, as part of that agreement, I need to also make an assessment that what is the cost which I may end up incurring as part of dismantling, and that also I am allowed, or I am rather required to capitalize as part of property, plant, and equipment. And of course, we will try and understand this with the help of several example as we kind of understand this. Yeah, we're going to cover this now in the next slide. So the major inspection cost, of course, that also is required to be capitalized, and we will also talk about this, right? As we're trying to understand different concepts, let's just try and do this with the help of this example on the purchase and direct cost. So the question here is, please advise Caliber Limited on the cost that can be capitalized. And we have this relevant information, which is Caliber is installing a new machinery at one of its facility. What are the following costs are incurred? So cost of machinery is 32 lakhs, including non-refundable taxes. I think that's the important piece of information we've got here. Delivery and handling cost 1 lakh, site preparation cost 2 lakhs, consultant used to advise on the acquisition of the machinery 3 lakh rupees. So the question is that how much cost out of that is can be capitalized, and as if you remember what I said, that cost which is directly or incremental to bringing the asset to its present condition and location, right? That is the cost which is eligible for capitalization. So in this example, the cost of machinery is capitalizable, the delivery and handling cost is capitalizable, the site preparation cost is capitalizable, and the cost of the consultant, because it's also directly attributable to the acquisition of the machinery, right? So if you look at the answer, 38 lakh is what we have. All of this is to be recognized as the cost of acquisition of the plant. All right. Okay. So let's look at another example. Okay. Here, Potential Limited purchased a machine on June 1 of 2019 under the following terms. List price of machine is 8 lakh. Non-refundable import duty. That means it is not which you can get a adjustment against your other tax liabilities. Is 50,000. Delivery fees is 10,000. Installation cost is 100,000. Pre-production testing is 40,000. Pre-production testing cost. Okay. And purchase of a 5-year maintenance contract with vendor has costed us 70,000 rupees. So the question is, the supplier has provided Potential Limited trade discount of 10%. So I have a trade discount of 10% on the list price. Further, if the payment is made within 30 days of the purchase, Potential Limited will receive an early settlement discount of 1%, right? Potential Limited settled the payment on June of 2019. In a way, it earned also this 1% settlement discount of 1%. At what cost the machinery will be capitalized, right? So we've got a list price of how much? 8 lakhs. So, and we got a discount of 10%. We were paying a non-refundable duty 50,000. We have delivery fees of 10,000. Installation cost of 100,000. Pre-production testing of 40,000. Right, and all of that. So let's just look at the answer, right? What is it, and also what do we do this 1% of settlement discount, right? Is this to be reduced from the cost of the plant, or is to be treated as other income, right? It is a matter of judgment, and it is something which is you got to assess whether it's actually a discount which is given as an incentive to make the early payment, or it's actually a discount which is to be linked to the acquisition, may help you, right? And again, this is a matter of judgment, I would say, and you appropriately, if you were to deal with this question appropriately, make that assumption, right, from that perspective. So when I look at again, India 16, all cost required to bring an asset to its present location and condition for its intended use. The important thing is all cost for present location and condition for its intended use should be capitalized, right? Therefore, the initial purchase price of the asset is going to be, right, whatever the cost which we have incurred, which is the list price of 8 lakh rupees less the 10% of trade discount. Okay, we get to 7,20,000, add 50,000 of non-refundable duties, delivery fees of 10,000, installation cost of 100,000, and production testing cost of 40,000. All of these costs are important for us to be incurred in relation to make this asset relevant for its present condition and location. The total is 9,20,000 is the cost to be capitalized. Now we left with the two questions, right? One is the settlement discount, the other one is the maintenance. Okay, so maintenance is a separate contract to get service and not a cost necessary to bring the asset to its present location and condition. Therefore, the maintenance contract cost of INR 70,000 should be recognized as a prepaid expense and charged the profit or loss as expense over a period of 5 years. Now, this is important, and similarly, let's say if I were to relate this with some other examples, right? Let's say when you go and buy an automobile, say for 10 lakh rupees, and the sales guy say that you'll get 3 services free, right? So if you're getting a 3 services free as part of your automobile, right now, that's this thing, right? That's not, there's nothing called free. Okay, there's nothing called free. So if there are 3 services free, that's nothing but maintenance, right? And the cost of those 3 services needs to be taken out from the cost of the plant itself, all right, or the cost of the automobile in that example. Here, since we have the separate information, 70,000 rupees, we're going to take it out, all right? Or we're not going to consider that for the purpose of capitalization. Okay, so 70,000 should be recognized as a prepaid expense and charged to profit or loss as expense over a period of 5 years, right? Now, the settlement discount of INR 7,200 should be recognized as other income. Now, this is an area which is a matter of judgment. We have another example in which we're going to say that if the discount would have been not 1% but 5%, right? Then or maybe 2% also, right? Or 3%, then possibly one could have argued, right, that that this also is like an additional discount which is offered from the cost of acquisition for the plant itself, right? And hence not to be treated as other income. Okay, so important, very simple. There's no complexity in it. You got to remember, apply your logic as to what should be the cost of the acquisition, is what cost you incur to bring the plant to its present condition and location. Cost which is not necessary, not important, like maintenance, right? It's not related to the cost of acquisition, but the subsequent operation of the plant, that is not related to the capitalization. That's a subsequent cost. All right. Let's look at this example. Okay, here we have questions around deferred credit. Okay, so what is deferred credit? Deferred credit is, let's say when you're purchasing something and you're saying that I'm going to delay the payment, right? I'm going to delay the payment and make the payment after a point in time. So what essentially is happening here is that there is an embedded interest component, right, which is related to the cost of the plant. So if there is a embedded, so to say, interest which is there in the cost of the plant, so we need to take it out. We need to take it out, right? That's a financing cost to be dealt accordingly. Okay. Now, Success Limited, a developer, has offered a property for sale at a consideration of INR 10 lakh on April 1, 2020. Okay, a developer has offered a property for sale at a consideration of INR 10 lakh. Okay, on April 1, 2020. Okay, the payment for the same is to be made in 3 equal installments of 3,33,333 over a 2-year period. Okay, now payments are due on April 1, 2020, March 31st, 2021, and March 31st, 2022. Success Limited has offered a 5% discount if the payment is made immediately at the time of sale instead of over a period of 2 years. Implicit interest rate is 5.36 per annum. Okay. How will the property be recognized in the books of the buyer, assuming that the buyer makes the payment over 2 years? So essentially, you've not taken this 5% settlement discount. That means you're going to make 3 installments. So the question is, what is the cost of acquisition of the plant? The total cost is 10 lakh. I would have got a discount of 5% if I had made payment upfront, which I have not. So how much I should capitalize, how should I do the accounting, right? So when you look at this again, the cost of an item is cash price, equivalent cash price equivalent at the recognition date. Here there is a deferral credit, right? If payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest over the period of credit, is recognized as interest over the period of credit unless such interest is capitalized in accordance with Ind AS 23. So this interest is also possibly eligible for capitalization, but may not be in relation to this asset, but maybe in relation to some other capex, because that has to be a qualifying asset. And we don't have enough information here, which makes us believe that this is a qualifying asset, right? So basis the above guidance, the buyer will recognize the property as follows. So property, plant and equipment of 9,50,000. So from 10 lakh, right? I made the total payment of 10 lakh, and there is a 5% discount, right? So that gives me 9,50,000. Okay, 9,50,000, which is a property, plant and equipment debit to cash, which is the year one installment which I paid, to accounts payable, and then I'm going to record an interest expense of 33,053 and accounts payable and to cash, and I'm going to record another entry which is 16,000 interest now I'm going to pay, and accounts payable of 3,16,000 to cash of 3,33,334 rupees. All right. Okay, so that's where we are, right? In terms of the overall situation, the accounting entries. The important point here is that unlike in the one of the example which we saw, where the settlement discount was 1%, we said that that's a matter of judgment, and one would have argued and treated that trade discount, settlement discount, not the trade discount, settlement discount as an other income, right? Now here, because the settlement discount is like 5%, right, which is very substantial, and the deferral is also like 2-year period, so akin to a embedded financing, and so I need to take that out from the cost of the plant and machinery, right? It has to be, if I were to purchase it on normal credit terms, right, how much is what I was supposed to pay, and if that is equal to so to say 9,50,000, because 10 lakh with 5%, 9,50,000, that's what I need to pay. All right, and that's what is what I've capitalized, and then that interest is what I recorded based on the effective interest rate method, and we have the we also had the information on the effective rate of interest as well on the as part of the question. Let's look at an example of other cost, and it's a good example which we're trying to cover here. So and I talked about this the asset restoration cost, right? So in this example we're talking about the restoration cost. So so we talked about, right, restoration cost. So if you see this example, on 30th September 2019, Limited brought into use an industrial site, right, that had been constructed at a total cost of INR 5 crore. Has the right to use the site for a 10-year period, right? The period over which I can use it is a 10-year period, at the end of which the site has to be returned to the legal owner in its original condition. management estimate that the cost of restoring the site 10 years later on 30th September 2029 will be 1.5 crores. Okay. The construction cost includes the right to use the site without further payment for 10 years, so that no more payment needs to be made. The rate to use in any discounting calculation is 8%. So that information is provided. The present value of INR 1,000 receivable in 10 years when the cost of capital is 8% is INR 463, right? How much I need to spend after 10 years? 1 crore 50 lakh. How much I've spent today is 5 crores. So discuss the treatment of restoration cost to be shown in the financial statement of Limited as at 30th September 2020. That means after 1 year, right? I purchased this at 30th September 2019. And there's several examples of this type is what we see very commonly, and you need to be very clear that how you need to account for this at the time of initial recognition. Try and understand, we are talking here initial recognition. Okay, so how much I need to capitalize at initial recognition, then how do I need to deal with subsequent measurement? Okay, initial recognition on which date is on 30th September 2019, right? Subsequent measurement at every subsequent reporting period, and in this case it is 2020, September 2020, right? So we need to understand this and in a way then deal with this as to what is the initial recognition and what is the subsequent measurement. So we're going to go through this example and again focus here because this is important for you to understand that how do these elements of discounting and all of that in a way going to operate, right? So I'm going to do the first accounting here. The Ind AS requires that the cost of an asset includes an initial estimate of the cost of restoring the site. That means when you look at this 1,50,000 and then you go to multiply it with the present value of 8%, right? And that information was given as 463. For 1,000 it is 463. So 1 crore 50 lakhs multiplied by 0.463 equals to 69,45,000 is what you need to capitalize along with the cost of the asset. The amount of INR 69,45,000 is recognized in property, plant and equipment and is also depreciated over a 10-year period. The provision is increased over time as the discount unwinds. At the end of the day, I have to spend how much? 1.5 crores. And I have only capitalized here 69,45,000. That means I need to also provide for an interest cost by way of unwinding of discount at the rate of 8%. This is nothing but a simple present value accounting concept. So if I have to incur a cost after 10 years, which will equal to say 100, how much is the present value of that 100? And in this example, the present value of that 100 is nothing but, the delta, if you were to take it at an 8% cost of capital, is 463, right? In the context of 1,000, right? And that's what you capitalize, and then but I have to still spend 1,000. So on this 463, at every measurement date, I'm going to record interest at the rate of 8% by way of an unwinding. So if I look at my income statement for the year 30th September 2020, I'm going to record a depreciation of 56,94,500, which is it's a 10-year property, right? It's a 10-year usage. So I'm going to record on 5 crore, right? I'm going to record on 5 crore plus on 69,45,000 divided by 10, and that gives to me 56,94,500, right? That's my depreciation cost. And then on 69,45,500, I'm also going to record 8% unwinding, which is 5,56,000. That's my total cost in my period. Now, when I look at the balance sheet presentation, my property, plant and equipment will be the total cost which I have capitalized is 5 crore 69,45,000, and then I'm going to reduce by amount of depreciation which I have charged, which is 56,94,500. So the net amount which I'm going to carry in my balance sheet as a property, plant and equipment is 5 crore 12,50,500, which is nothing but 5 crore 69,45,000 here. I'm going to reduce this 56,94,500, right? And you go to minus this, and this is what you will get, 5 crore 12,50,500. That's your value which you will carry in your balance sheet. So this is my original cost. right? And this is my, the depreciation in a way. And then I'm also going to carry a liability, right? There's a liability of 69,45,000, which is the original liability which I created, this liability, because I have to pay this after 10 years. And then I've recorded an interest cost on that for 1 year, which is on 5,56,000, which is 75 lakh 75 lakh 1,000 is what I'm going to record as my liability. And then year 2, I'm going to record interest cost at 8% on 75 lakh. Similarly, I'm going to depreciate 56 lakhs. My depreciation cost will be constant, right, throughout 10 years period, unless we change the facts. So in this fact pattern, my depreciation cost every year will be 5,12,500. Whereas my interest cost will change every year. Why my interest cost will change every year? Because we are following an effective interest rate method, right? In an effective interest rate method, you calculate the interest in relation to the outstanding liability on the balance sheet. So now at inception, my outstanding liability was 69,45,000. Hence, in year 1, my interest cost was how much? My interest cost was 5,56,000, right? Now in year 2, because now your carrying value has changed to 75 lakh 1,000, and now if I have to apply 8% to 75 lakh 1,000, that number comes to 6 lakh, right? So in year 2, my interest cost will be 6 lakhs. Similarly, then I'm going to add this to my carrying value, it becomes 81 lakhs. And then similarly in year 3, my interest cost will further become 8% on 81 lakhs, and so on and so forth. So that at the end of the 10th year, this amount will be back to 1 crore 50 lakhs, right? That's how the whole present value accounting and the effective interest rate method in a way operates. Now we're going to move forward, right? We're going to move forward and look at some more example as to how do we in a way deal with the initial recognition. Remember, initial recognition, the cost has to be reliably available, right? And there has to be economic benefit which has to flow to the entity. And then what all in a way go into the recognition. What all go into the recognition is the purchase cost, is the directly attributable cost, and there are other elements of cost. And some of the other elements of cost we talked about, like the restoration cost, the dismantling cost, all of that also needs to be capitalized. And we talked about deferred credit period. If there's a deferred credit period, you need to adjust the cost of financing, right? And in a way deal with them appropriately. Now we're going to talk about exchange of assets. So there are two types of transaction, which monetary transaction and a non-monetary transaction. Monetary transaction is where you're going to settle this by way of payment of cash or by way of another financial asset. Okay. Now, when you talk about a non-monetary transaction, where you're actually exchanging one asset for another asset, and you may also pay a component of cash or another financial asset, in that perspective. Now, Ind AS 16 also requires you to record all such exchange also at fair value. Right? Now, remember, this is also required to be recorded if acquired in exchange for other non-monetary asset or for a combination of monetary and non-monetary asset. Then you need to measure the cost at fair value, right? Unless the exchange transaction has no commercial substance or fair value of neither the asset received nor given up can be reliably measured. So if you cannot measure it, of course, you can't do much because remember the two conditions, it has to be reliably measurable and there has to be economic benefit. So if I simply extend both the arguments, so in any exchange of one asset for another asset, the Ind AS 16 expects you to record them again at fair value, provided there is a commercial substance. If there is no commercial substance, of course, that means that's a bogus transaction and you don't need to record for that transaction. You continue with your status quo or the cost has to be reliably measurable. The information has to be available for you to determine the fair value. If the acquired item is not measured at fair value, its cost is measured the carrying amount of the asset which is given up. right? So fair value of neither the asset received nor given up can be reliably measured. Anyway, you can't do much. But if the acquired item is not measured at fair value, its cost is measured at the carrying value of the asset given up. So if there is an asset which is already carrying, then if you can't determine the fair value, then you simply replace it, right, with the asset which you have given up in a way from that perspective. Let's look at the example of the on the concept we just talked about. Okay, so here we are talking about exchange of one asset for another asset, and there is some in a way cash also being involved. So the question here is Alpha Limited acquires a plant on 1st of January 2020. Okay, all the dates are very important. Okay, so Alpha Limited acquires a plant on 1st of January 2020, whose fair value on that date is INR 18 lakh. Okay, whose fair value on that date is INR 18 lakhs. Now, Alpha Limited acquires the plant by exchanging its land and building, whose fair value is INR 15 lakh. Okay, so I've acquired the plant and the fair value is 18 lakhs. Okay, and how am I paying for this? Acquire the plant by exchanging its land and building, whose fair value is INR 15 lakh, and pays the remaining balance as cash consideration. All right, the carrying value of this land and building as on the date of exchange, which is 1st January 2020, is INR 10 lakh rupees. Ignore taxes. How should the above transaction be recognized under Ind AS 16? So it's a non-monetary exchange, right? So I'm acquiring one asset. In exchange, I'm giving up another asset, and I'm also paying cash here. Some portion of the consideration is paid by way of cash. The question is, how do I account for it? So recognition of one asset, it's a derecognition. So I'm going to look at Ind AS 115, right? So there has to be a commercial substance in the transaction. So assuming there is a commercial substance in the transaction, I'm going to derecognize 15 lakh. I'm going to derecognize my 10 lakh rupees worth of asset, which is then my balance sheet. I'm going to record a new asset which is worth 18 lakh. Right, and I'm going to record a gain or loss, and I'm also going to pay cash, right? That is essentially what I'm doing here. So the important thing for you to remember in your assumption, what you need to mention is assuming the transaction has commercial substance, right? Assuming the transaction has commercial substance. And what's the meaning of commercial substance? The meaning of commercial substance is, why am I doing this transaction, right? Now, for me to do this transaction, it has to have an impact on my future cash flows. It has to have an impact on my risk and rewards, right? So is this making a business sense for me or not? If the answer to that is yes, that means it has a commercial substance, right? Alpha Limited should capitalize the plant at a cost of INR 18 lakhs, which is a fair value, and should recognize a profit on disposal of the land and building of INR 5 lakh as explained in the table, which is fairly simple. Recognition of fair value, less carrying amount of land and building, less cash consideration, and profit is 5 lakhs. Required journal entry: property, plant and equipment, debit 18 lakhs. To PPE, land and building 10 lakhs, to cash in bank 3 lakhs, and to profit on disposal of assets 5 lakhs. Now there are certain elements of cost which are not eligible for capitalization. Okay, and in this example we will also try and understand that what is eligible for capitalization and what is not eligible for capitalization, right? So if the cost which is incurred in opening a new facility, right, ribbon cutting charges, right, so that is generally not an eligible cost which is allowed to be capitalized. Training cost, if you train your staff to operate the plant, that's not a cost which is eligible for capitalization. Administration and general overhead, of the general management staff and all of those costs, headquarter cost, all of those are not eligible for capitalization. Advertisement and promotional activities, these costs are also not eligible for. Let's say you're building a plant and you're coming out with a product, and the process you started doing marketing for that. Now that cost is also not eligible for capitalization. from that perspective. Let's try and deal with this with the help of following example as to say what is eligible for capitalization and what is not eligible for capitalization. So we're going to look at this example. Management of Gamma Limited is setting up a new factory and will introduce its product to that market. I'm setting up a new factory. In relation to the same, I've incurred the following cost. Okay, lots of different information I have here. An important thing for you to again remember the principle, right? Is that is this going to bring are these costs helping me to bring the asset to its present condition and location? Okay, so my site preparation cost is 1500, my material cost is 20,000, my direct labor cost including INR 100 incurred during an industrial strike looks like an abnormal cost. So total is 11,600, testing cost for processes, consultancy fees, 3,000, relocation of employee to new factory 4,500, general overhead 5,500, dismantling cost 2,000, total cost to be capitalized. So what you need to look at here is that what is eligible for capitalization and what is not eligible for capitalization. That's the important thing. So here if I see this is clearly eligible, this is clearly available here. Now this 100 is what is important. So not the entire thing, okay? So it has to be minus 100, okay? So 11,500 possibly is eligible for capitalization. Now, testing cost, yes, testing cost we need to do. Consultancy fees, yes, right? You got to pay advisory and that's incremental, right? Relocation to employees. Now the question is relocation to employees. Is this important for the plant itself, right? The answer is no, it's not important. So it's not. General overheads are not eligible for capitalization. Dismantling is yes, it is required. This is a principle which is required under India 16, which has to be considered. Okay. So now let's look at the solution. So Moon Limited incurs the following cost in relation to the construction of a new factory and the introduction of its product to the local market. So what all is eligible? So here if you see, we've taken out this 100. So 1500 yes, 2000, 20,000 yes. This 100 is taken out, which was abnormal cost. Abnormal costs are not eligible for capitalization. Okay. They are a period cost. This 2000 yes, 2000 yes. This 4500, which is a relocation cost, that also is not eligible for capitalization. 5,500 is also not eligible for capitalization. 2,000 yes. So all of that put together is 40,000. Answer is 40,000. All right.